আসসালামু আলাইকুম সিমরান ম্যাডাম। হ্যালো, হ্যাঁ ডেন ক্যাপ্টেন, হ্যালো, আমি আব্দুল হালিম বলছিলাম। হ্যালো,
আসসালামু আলাইকুম স্যার।
ভালো ইয়ে আমি একটু ওই যে আমি অফিসে আছি, কিন্তু আমাদের এখানে নেটে একটু প্রবলেম করতেছে, তো এই জন্য হয়তো একটু দেরি হবে। তো এই জন্য মে আই রিকোয়েস্ট অ্যান্ড আই থিঙ্ক আওয়ার মোস্ট রেসপেক্টেড আওয়ার স্যার গার্ডিয়ান, আমাদের শ্রদ্ধেয় সিও স্যার হয়তো চলে আসছেন। হ্যাঁ, তো আমরা মনে হয় শুরু করতে পারি। আর আজকে মূলত আমাদের 6th রাউন্ড। By this time I have sent the consent synopsis and I believe that you have taken proper steps. যদিও নাও হয়, সামনে গুলো রেখে আমরা ক্লাসে যোগদান করি। আর দ্বিতীয়ত হলো যে রেসপন্স আগের মতো ওইভাবে করি। আর এটা মূলত ল্যাপটপে আসলে ভালো হতো, আমি তো মোবাইল থেকে। তো যেটা বলতে চাচ্ছি যে আজকে লাস্ট সেশন বিফোর ইওর এক্সামিনেশন, এই জন্য আমাদের শ্রদ্ধেয় গার্ডেনকে আমি রিকোয়েস্ট করব যে আপনাদের হাসি মুখে স্যারের কাছে আমরা বিদায় নেব, আর স্যারকে মানে ক্লাস থেকে। আর আরেকটা হচ্ছে স্যারের জন্য আমরা দোয়া দিব এবং স্যারের কাছ থেকে ভালো পরীক্ষা দিতে পারেন। কষ্ট করে অনেক ক্লাস নিলেন, 6 দুগুণ 12টা, সেই জন্য স্যারের থেকে দোয়া নিয়ে না শুরু করেন। আর কালকে একটা আমাদের ওই যে ডিআরসি একটা ইয়ে করেছে এক ফাঁকে কিছুক্ষণ সময়ের জন্য, কি বলে যে ওই সেশনটা এক্সাম নলেজ শেয়ারিং একটা মনে সেশন, ওরা আধা ঘন্টা একটু আপনারা সময় দিন এবং ওইটা ক্লাসে আমরা ইম্প্যাক্ট করবো না এভাবে প্রোগ্রামটা। ওই জন্য মেল যাবে, আপনারা মাই রিকোয়েস্ট ইউ উইল জয়েন দেয়ার, ওকে? আর আমার মনে হয় যে স্যার চলে আসছেন, কাজেই স্যারকে হয়তো আমি রিকোয়েস্ট করি স্যার যোগদান করুক। আর যেটা বলার যে ব্রেক যদি প্রয়োজন হয় অথবা আলাপ করে স্যারের সাথে নির্দেশনা নিয়ে সেশনটা শেষ করেন। I wish your effective session and actually on behalf of you my lay gratefulness to upon our sir. আপনাদের পক্ষ থেকেও আমি স্যারের প্রতি কৃতজ্ঞতা জানাচ্ছি, কারণ আজকে ক্লোজিং সেশন এই সেকশনের, শুক্রবার আরেক সেকশনে হবে। তাহলে আজকে 6 রাউন্ড আর সিনপসিসটা সামনে রাখি, আমরা ক্লাসে যোগদান করি, ক্লাসে মনোনিবেশ করি এবং যথাপারত রেসপন্স থাকি। এই বলে আমি বিদায় নিচ্ছি। আর স্যার, আমি ইওর হালিম স্যার, and actually now I mean not video, audio, so you may kindly also start the class and also continue, and that's to closing of you. Yes sir. So, sir,
আসসালামু আলাইকুম স্যার। স্যার দোয়া করবেন স্যার। হালিম স্যার,
স্যারকে আসার জন্য বিনীত অনুরোধ করতেছি স্যার। You may kindly start, sir. আদাব স্যার।
Alim Shahab, have you finished?
Sir, I have finished, sir. You may kindly start, sir. Thank you, sir. Ji, adab, sir. Please.
Okay, so good evening to everybody and welcome to this session. I believe you have been given a handout, and that handout has got a number of questions as usual. So if you have the handout with you, then you can go through it one by one. Number one question here. Mr. X is a businessman who submitted a return under section 75, showing an income of Taka 50 lakhs for the assessment year 21-22 and 2021 and 2022. Afterwards, he found out that the income was not correct for the income year. That means he has found out one error, maybe, or mistake. He had some other sources of income, like from fisheries, that was not actually shown in the return when he submitted the return for the first time. That means the original return was submitted by him. So he decided to revise the return showing the income from the fisheries sector. Accordingly, he submitted to the Deputy Commissioner of Taxes a revised return under section 78. So the Deputy Commissioner of Taxes did not accept the income of fisheries as exempted. He added that income to the total income, and the total income stood at 85 lakhs. So what would be the implication on the income of the SSC? What suggestions would you give the SSC? So here are a number of things to discuss. Number one is that the SSC submitted the return under section 75. That means when he submitted the return within the tax day. That means by the 30th day of November, he submitted the return. Or by the extended period. If the extended period is made by the National Board of Revenue, it could be treated as the tax day. As in the previous year, that means previous assessment year, when return was submitted by the SSC, they could not do it because of pandemic situation. That's why the National Board of Revenue extended the time of submission of the return, and the time was 31st December 2021. So if you submitted the return by the 31st day of December 2021, that was also within the tax day. So that's why there was no obligation on the part of the SSC to submit the return, and there was no question of being penalized. So that was treated, that a return was submitted under section 75. However, the person who submitted the return under section 75, he showed an income of Taka 50 lakhs, maybe from his business. And afterwards, he found out that he actually missed to show one source of income, which was from fisheries sector. And as per SRO, the income from the fisheries was exempted. Exempted means at a reduced rate, and the SSCs were required to buy some instruments, government instruments. So that was as per the direction of the board. But what we can say is that subject to the fulfillment of some of the conditions, this income is exempted. So what he did, he actually showed income from his fisheries at 25 lakhs. So his total income stood at 75 lakhs, because in the original return he showed income of 50 lakhs. Now he has shown another income from the fisheries sector at 25 lakhs. So the total income he showed was 75 lakhs. However, 25 lakh was exempted, so he claimed it exemption. So the DCT, while accepting the return, he could not accept it under section, 75, because maybe the time was over and the return was not within the tax pay. If it was within the tax pay, it was also not accepted under section 82BB or under section 82, whatever it is. That means it was not accepted by the DCT under the self-assessment scheme. So what the Deputy Commissioner of Taxes did in this case is that he enhanced the income. That means the total income calculated by the Deputy Commissioner of Taxes was 85 lakhs. So we can say that the Deputy Commissioner of Taxes accepted the income shown by the SSC, which was from his business, that is 50 lakhs. But with regard to the income from this fisheries sector, the DCT did not accept that income. Rather, he enhanced it to 35 lakhs, and that's why the total income was calculated at 85 lakhs. So that was the assessment. So whether the DCT was right in making the assessment like that, that means by not accepting the income which was shown by the SSC, that is the exempted income from the fisheries sector. And as per income tax ordinance and as pharaohs, whatever it is, whether it was the proper action taken by the Deputy Commissioner of Taxes or not, that is the question. The question is asking you to suggest the SSC what to do, whether the DCT was right in taking his action or he was not right, and whether the SSC can do something. That means whether he can prefer an appeal or not, something like that. So what are the implications on the income of the SSC? That is the question. Any idea? First, you have to understand what the legal provision should be with regard to this. The SSC submitted return under section 75, that was okay. However, he did not stick to that. Rather, he found out that there was an error in the income which he originally showed. And afterwards, he decided to submit a revised return under section 70. That is also okay. There is no problem with that. Revised return could be submitted within the tax day or beyond the tax day. That was a different issue. If you submit the revised return after the tax day, then your return would be treated as a normal return. But if you submit it within the tax day, then it would be treated as the return submitted under section 82BB. That means under the self-assessment scheme. So here, the SSC actually showed some income from fisheries which was exempted or at a reduced rate, whatever it is. And now what the DCT did, he did not accept the return, rather he enhanced the income of the fisheries sector to 35 lakhs, and hence the total income was assessed at 85 lakhs. So what it means is that the DCT did not accept the returned income, what was submitted by the SSC. Whether he was right? Yes, he was right, because you have to look at section 1931. In section 1931, what is said, you can go through it. So if you go through that section, section 19, subsection 31, it is said here, where an SSC files a revised return or an amended return under section 78, 82BB, or 93, and shows in such revised return or amended return any income that is subject to tax exemption or at a reduced tax rate, or any income derived from the sources mentioned in paragraph 33 of Part A of the 6th schedule. So much of such income as exceeds the amount shown in the original return shall be deemed to be the income of the SSC for the income year, classifiable under the head income from other sources. So here the new income, that is 75 lakhs, it was shown by the SSC in the return. 50 lakh was claimed as income from business, which was liable to be taxed, and another income of 25 lakhs, which was claimed to be derived from fisheries sector, which was also claimed to be exempted from tax. So total income comes to 75 lakhs taka, but his original income was 50 lakhs, what he showed in his original return. So the difference between the two is 25 lakhs taka. So this 25 lakh taka could be treated as income from other source by the Deputy Commissioner of Taxes. However, the Deputy Commissioner of Taxes enhanced it. That means in place of 25 lakhs, he enhanced it to 35 lakhs. So the first action, which was taken by the DCT, that is rejecting the shown income in the return, that was right on his part. But the second part was that he enhanced the income, and you may suggest to the SSC to prefer an appeal to the appellate joint commissioner or appellate additional commissioner for reducing the income to 25 lakhs of taka, as you showed in the return. So that should be the suggestions to be given to the SSC by the chartered accountant. That means you being the chartered accountant and the SSC being the client, you can suggest the client to resort to that action. Is it okay for you? I believe it is okay for you. You go through section 19, subsection 31, and then also go to Part A of the 6th schedule, paragraph 33. There are some incomes shown there as to be exempted from tax, but there could be some other incomes which are shown in SROs. That means those are also exempted from tax through SROs. So they will also come under this purview. Number 2 question, if you go through it, XYZ is a private limited company which has got a capital of 5 crores. The company earned an income of 50 lakhs for the income year. 2021. The company felt the necessity of buying 2 jeeps from the Pragati Limited for company's operational activity and official use. The company had an accumulated reserve of 50 lakhs. The cost of 2 jeeps was 1 crore 40 lakhs. What would be the treatment of this transaction from the perspective of income tax by the Deputy Commissioner of Taxes? What should be the income of the company for the assessment year 2021-2022? Assume that the tax rate of the company is 45%. What should be the calculation of tax to be determined by the Deputy Commissioner of Taxes? So all these are very known questions for you. Here you have to make some assumptions. The assumption is that XYZ is a private limited company which has got a capital of 5 crores. So you have to assume that this 5 crore is a paid up capital, not an authorized capital. So that you have to assume here. This is the paid up capital. The company earned an income of 50 lakhs for the income year 2020-2021. So this should not be taken into account because that is the income you earned during the income year, and you should pay taxes on that. That is a very usual matter, and you have to do it usually, whatever you do every year. The company felt the necessity of buying 2 jeeps for operational activity or official purposes, whatever you say. And the 2 jeeps actually cost the company 1 crore 40 lakhs. That means 70 lakh each. What should be the treatment of this transaction from the perspective of income tax? That means what the Deputy Commissioner of Taxes would do with regard to the purchase of the 2 jeeps from the Pragati Limited by the company. And you have got some information with regard to that. And then what should be the income of the company for the assessment year 2021-2022? Because income has been shown at 50 lakhs. Maybe that is from the business, that is operating profit, you should say. And then you have to calculate the total income after taking into account the transaction of purchasing 2 jeeps from Pragati Limited. And then the tax rate has also been given, which is 45%. That does not matter because whatever rate is there, you have to apply that. If it is 25%, you will apply 25%. If it is 30%, you will apply 30%. So that is not a very important factor for you, but you should calculate the tax. And now you just give us the way that the DCT will treat it. Which section you have to go to? You have to go to section 19, subsection 27. So if you go to section 19, subsection 27, you will find the limitations on the purchase of jeeps or cars by a company. If you have the income tax ordinance, you can go through it. Let us see what is said there. Section 9, subsection 27. Here it is said, where an SSC being a company purchases directly or on hire 1 or more motor car or jeep, and the value of any motor car or jeep exceeds 10% of its paid up capital, together with reserve and accumulated profit, then 50% of the amount that exceeds such 10% of the paid up capital together with reserve and accumulated profit shall be deemed to be the income of such associate for that income year, classifiable under the head income from business, income from other sources. So here what you have to do, you have to find out 10% of the paid up capital plus the accumulated profit. As I have said to you before that, Taka 5 crore is to be assumed as the paid up capital. So paid up capital is 5 crores Taka. And you have also got the information of accumulated reserve, which is Taka 50 lakhs. So your total of paid up capital plus and reserve profit should be 5,50,000. Paid up plus accumulated reserve. These two together is Taka 5 crores 50 lakhs. So 10% of this is 55 lakhs. So what is the purchase price of the chips? It is 1 crore 40 lakhs. So 1 crore 40 lakhs, it exceeds the amount of Taka 55 lakhs. That means 10% of the paid up capital plus the accumulated reserve. So 55 lakhs and 1 crore 50 lakhs. What is the difference between the two? So difference between the two is, I believe, 85 lakhs. And this 85 lakhs, 50% of that amount, that means 50% of 85 lakhs, it should be 42 lakhs 50,000. That should be treated as income from other source. And it will be taxed. So what would be the total income of the company? Total income of the company would be 50 lakhs Taka. That means the company earned an income of Taka 50 lakhs. We have said 50 lakhs plus 42 lakhs 50,000. That means 92 lakhs 50,000 Taka would be the total profit of the company. And tax would be calculated on this figure at 45%. So 92 lakhs 50,000 times 0.45. That should be the amount of tax to be assessed. So that is the answer to this question. If you are clear about it, then it is okay. Otherwise, you can ask me a question if you want to ask. It's okay for you or not?
Yes, sir. Okay, sir.
Good. If it is okay, then we can move to the next question. Number 3. Mr. A started business in export of ready-made garments in the year 1985. Given a quota by Export Promotion Bureau of Bangladesh to export garments worth $1 lakh US. However, in the course of operations, he faced some problem and sold out 50% of the quota to somebody else. But he showed an income amounting to 0 in his return for the concerned year. So what would be the calculation of income in the assessment year to be framed by the DCT? Okay, any idea about that? So here, Mr. A, he is a businessman in ready-made garments. That means he manufactures ready-made garments in Bangladesh, then exports them to the global market. That means to foreign countries. So in 1985-86, he was given a quota. Quota means there was an allotment of quotas by the government to different ready-made garments manufacturers, because you could not export any amount of ready-made garments to the developed countries. It was restricted by the developed countries. It was restricted because they allowed their companies to reduce their business in phases, and afterwards their businesses closed down. So all of a sudden, it was not possible to close down their businesses. Rather, they took some time in order to allow their businesses to close down. And that's why they did not import ready-made garments from the least developed and developing countries in any quantity. So there was a restriction on the quantities of ready-made garments to be exported to their countries. So that was called MFA, multi-fiber arrangement. And there was also an act which was called the Clothing and Textile Act 1974. So under this provision, that means the Clothing and Textile Act, and afterwards the MFA, multi-fiber arrangement, a quota system was introduced. That means there was a block. Block means a block of developed countries. They determined the quantity of exports from other countries. They allowed Bangladesh to export ready-made garments worth US dollar maybe 100 million. That was the figure allotted to Bangladesh. They also allotted another quota to Vietnam, also to India, also to Thailand, etc., etc. Bangladesh was given a quota. So let us suppose that the quota that was given to Bangladesh was US dollar 100 million. What Bangladesh should do? Bangladesh has to allocate that quota among the ready-made garments manufacturers. So let us suppose that there are 100 ready-made garments manufacturers. So the government of Bangladesh would allocate the quota that was given to Bangladesh among the 100 ready-made garments manufacturers. So that's why it has been said that Mr. A was given a quota worth 1 lakh US dollar. That means he could export ready-made garments worth 1 lakh US dollar. So that was the allocation of the quota. But what Mr. A did, he had some problems with the manufacture of ready-made garments. So that's why he could not export garments to the rest of the world. And that's why what he did, 50% of his allotted quota was sold out to somebody else. Somebody else means another manufacturer. So that was what, 50,000 US dollar. And he sold it out to him. That's why he got income from that manufacturer. So he did not have any export actually for that years, and that's why he did not show any income in his return. But the Deputy Commissioner of Taxes, whenever came to know that he sold out 50% of his quota allotted to him by the government. By the government means by the National Board of Revenue or by the Export Promotion Bureau. So first of all, the National Board of Revenue was responsible for allocating the quota, and afterwards the Export Promotion Bureau under the Ministry of Commerce was responsible for allocating the quota. So let us suppose that the Export Promotion Bureau allocated that quota to that person, and now the Deputy Commissioner of Taxes has come to know that 50% of his quota was actually sold out to somebody else. So hence that should be treated as income. And the DCT should have issued a notice under section 93 asking him to submit the return showing that income. And afterwards he will make the assessment. So you should go through section 19 subsection 23. If you go to section 19 subsection 23, you will find out what has been said there. Let us see what is said here. Where during any income year, an SSE being an exporter of garments transfers to any person the export quota or any part thereof allotted to him by the government. Such portion of the export value of the garments exportable against the quota so transferred as may be prescribed for this purpose shall be deemed to be the income of the SSE for that income year, classifiable under the head income from business or profession. So if the quota allotted to him had been sold out to somebody else, the full quota or part of it, whatever it is, and income should be assessed by the Deputy Commissioner of Taxes as per prescription given by the National Board of Revenue. That means when the quota was worth US dollar 50,000, then there should be some sort of calculation that the Deputy Commissioners, that the National Board of Revenue prescribed for that year, and the city would have assessed the income to tax. So that should be the answer to this question. So the examiner will try to find out whether you know the particular section and subsection and how you have to treat it. So that is the question. And here I should say one thing. If the SSE has submitted the return for the assessment year 1985-86 and assessment was not completed, or assessment was completed, then provision should be one. And another possibility should be that the SSE did not show the income, did not submit the return showing any income because he thought that he did not have any business. So that's why he was not supposed to submit the return showing any income. So in that circumstance, the provision should be different. Now let us see or assume that the SSE did not submit the return for the assessment year 1985-86, and the assessment was not also completed by the Deputy Commissioner of Taxes. So in that circumstances, even now, the DCT, if it comes to his knowledge that in that year, the person concerned, he sold out 50% of his quota allotted to him, he can issue a notice under section 93 asking him to submit the return for the assessment year 1985-86, and he can assess him to tax. But if the gentleman submitted the return and assessment was completed, then the DCT now cannot issue a notice under section 93(1) because 6 years has already elapsed. So that's why he would not be able to ask the SSE to submit the return for that assessment. Yeah. So that should be the answer. You have to answer accordingly. You can now move to question number 4. Can the loan or advance given to a shareholder by the company in return of an advance conferred on the company by the shareholder be deemed as dividend in the hands of the shareholder? It is a case study actually, and the case study is that the loan or advance was given to a shareholder by the company. So the company gave loan to the shareholder in return of an advance conferred on the company by the shareholder. But earlier, the shareholder actually gave an advance to the company. So whether this should be treated as a dividend in the hands of the shareholder. That means whenever the company gave him an advance or loan, then that loan or advance, whether that should be treated as dividend in the hands of the shareholder or not. The answer should be the advance given to the SSE by the company is not in the nature of a gratuitous advance. Instead, it is given to protect the interest of the company. Therefore, the said advance cannot be treated as deemed dividend in the hands of the shareholder. And there is a case with regard to that, and the name of the case is Pradeep Kumar Malhotra, Calcutta High Court. So here what is said is that whenever a company has given such a loan to a shareholder, it is in the interest of protecting company's interest. That means it is for the protection of the company's interest. And that was not a nature of gratuitous advance. That means for nothing, it was not given. The shareholder first gave an advance to the company, and afterwards the company gave an advance to the shareholder. So it was not actually gratuitous in nature. And that was to protect the interest of the company. So the case reference you can make here, that is Pradeep Kumar Malhotra, Calcutta High Court. So this is what is said here, and you can just remember, if it is fits your case, if it fits your case in the examination, in that case, the answer should be like this. Okay. Then you can move to question number 5. What the provisions of deemed dividend be attracted in respect of financial transactions entered into the normal course of business. There is a case reference here, and the SSE was involved in booking of resort for the consumers of the companies and entered into normal activities. The High Court therefore held that such financial transaction cannot under any circumstances be treated as loans or advances received by the SSE from those concerns for the purpose of deemed dividend. It has been given in short, so I have to just elaborate it for your understanding. And it should be like this. A company was involved in business, that means hotel business or resort business, and the company also involved somebody or some concern to book resorts for the customers it was receiving in his hotel. So let us suppose that XYZ is a company, that is a hotel, and people are going to that hotel. But people who are going to that hotel would like to visit some resorts nearby or important resorts in that area. So what the hotel did, the hotel actually involved a particular person, and he was responsible for booking the resorts on behalf of the customers. That means the customers who are the boarders of the hotel. And for that reason, that person, he actually took some advances from the hotel in order to book the resorts for the customers. And the question was whether the advance money that was taken by that individual in order to book the resorts on behalf of the customers of the hotels would be treated as dividend or not. So it is not to be treated as dividend, rather it should be treated as a normal business. And the person who actually took advances from the hotel was supposed to get a certain percentage of commission, nothing else. So whatever amount he took from the hotel was to ensure the booking, because he did not involve his own capital in booking the resorts. Rather, he took the advance from the hotel and then booked the resorts. So it's a normal course of business. And by doing that, he actually used to get some commission from the hotel. So that was the thing what was asked here. And it was treated as normal business transactions on the part of the individual and the hotel. So that's why normal business as commission would be assessed in the hands of the individual, and whatever money was received by the hotel, that would be the business from business of the hotel as a normal course of hotel business. So the accommodation charges as well as traveling expenses to be borne by the hotel would be treated as the normal course of business on the part of the hotel. And two sources of income would be there in the hands of two SSCs. One SSC is the hotel, and the income of the hotel would be from business under section 28. And another SSC would be the individual who actually booked the resources on behalf of the customers, and he used to get commission from the hotel. So his income was income from other sources under section 33. So these were the two sources of income in the hands of two SSCs. Afterwards, you come to question number 6, whether income of an SSC can be estimated without any basis. That means the DCT, whether you can estimate the income of an SSC without any basis. So a case reference could be cited here. The main thing is that the Deputy Commissioner of Taxes cannot make an assessment without any basis. He cannot make an estimate of the income of the SSC. If I say that the income of an SSC is 50 lakhs, then I have to give an estimate and I have to show a basis. That means I have to depend on a basis. How I estimated the income of the SSC at 50 lakhs. If I have some sort of basis for the assessment, then it is okay. Otherwise, it is not to be treated as income of the SSC as valid in the eye of law. That means when the appellate authority will hear the SSC and will find that the income was estimated without any basis by the Deputy Commissioner of Taxes, then they will reject it or cancel it or set it aside. So the case reference could be made here. Mr. Ali Ajam, advocate, and the Commissioner of Taxes, South Zone, Chittagong, which was held in the High Court Division. That means it was held in Dhaka High Court, but the case was actually of Chittagong area, And the person concerned who represented the SSC was Mr. Ali Ajam, advocate, and defendant was the Commissioner of Taxes, South Zone, Chittagong. So there were two zones in Chittagong once upon a time. One was South Zone, another was North Zone. So this was a case between an SSC represented by Mr. Ali Ajam and the Commissioner of Taxes, Dhaka South Zone, sorry, Chittagong South Zone, and it was held in the High Court Division, Dhaka. So it was held that no assessment could be made without any basis. That means whether or when you make an assessment, it should be based on some clues which are actually true in case of a business. That means if I can make an estimate that the SSC sold out 50,000 units of products at a price of Taka 1 crore, in that case, I have to justify that, how it took place, who bought it, and how the SSC got the income from the purchaser. That means it was transacted through a bank or not. That is also a matter of question. If I can prove that the transaction took place through a bank and the SSC sold out its products to another person during that income year, and there was some bills, vouchers, etc., or documents, whatever it is, if I can prove it, then yes, I can actually prove my assessment to be true. And the appellate authority, whenever will evaluate it, cannot reject the assessment made by me. Otherwise, it could be rejected by the appellate authority. And the authority will say that it has been done without any basis, and that's why the assessment should be annulled. Annulled means rejected, or it could be set aside. That means the appellate authority could direct the Deputy Commissioner of Taxes to make the assessment afresh. So annulment and set aside, you have to understand the two terms here. Annulment, that means the assessment is cancelled because of some legal problems, that is the lack of issuing notices, or the DCT did not issue a mandatory notice. That's why it was annulled. So whenever a mandatory notice was not issued by the DCT, so he has to make a fresh assessment by issuing that notice and again taking the hearing. But when it is set aside means some lapses were there, and the DCT is directed to make a fresh assessment by considering some of the factors which were not taken into account that time. So that is set aside. So these are the two terms you have to understand. But sometimes the appellate authority can just direct you what to do. So they can direct you that the sale should be estimated at 50 lakhs in place of 1 crore, and the gross profit should be estimated at the rate of 20% rather than at 30%, and the net profit should be calculated at this figure after taking into account a certain percentage as the indirect expenses. So these are the directions to be given sometimes by the appellate authority. So you have to remember that the assessment should be completed on a basis, not on estimate, not on guess. Then you can move to question number 7, whether opportunity should be given to the SSC to explain his position when the DCT wants to enhance the declared income. The decity, when he wants to enhance the declared income, that means he will not accept the declared income which has been submitted by the SSC. Now he wants to estimate the income, and definitely he will tax it, and the SSC has to pay more taxes. So whenever such a decision is taken by the decity, for the sake of natural justice, he has to give an opportunity to the SSC, opportunity of being heard, meaning that the DCT can say that, okay, I want to estimate your income at 1 crore, but you have shown your income at 10 lakhs. I want to make it or enhance it to 1 crore. So in that circumstances, the SSC should be given an opportunity of being heard. That means he should hear the SSC, what he says, how he explains it, and he will also give his reasons why he wants to estimate his income at 1 crore. So the SSC will give his reasons that the income which he showed in the return was true, and the DCT will also say that because of various reasons we cannot accept that income. So there should be an opportunity of being heard. And there was also a case for this decision. That means in the case it was said, without any material basis and without giving an opportunity to the SSC to explain his position, his declared income cannot be rejected. Rejecting of such declared income as against the principle of natural justice. So here the focus has been given on natural justice. If you reject the income which has been declared by the SSC and which has been shown in the return submitted by the SSC without any reason, that will be the violation of the natural justice. If the DCT says that, okay, you have shown your sale at 2 crores, but you could not submit the vouchers. And in the previous year, you showed your sales at 2 crores. But this year, you have shown your sales at 1 crore. So why you have reduced the sale this year? If you have submitted all the vouchers in support of your sale this year, I would have accepted it. But since you haven't submitted the vouchers in support of your sale this year, and your sale was 2 crores taka in the previous year, so how can I accept it? I cannot accept it. So that's why the DCT can estimate the sale and he can enhance it to the previous year's sale. It is possible. And in that circumstances, the appellate authority will also accept it. And the appellate authority will say that yes, the sale has been estimated at 2 crores on the basis of the previous record. And the past record also says like that. The SSC earned in the sales revenue at 2 crores. But this year he has shown the sales revenue at 1 crore. But these are not supported by vouchers. If the SSC had shown vouchers in support of the sale of this year, but also he could show the revenue that was earned by the SSC through bank statement. That means the SSC could see that the revenue was actually reflected in the bank statement, and he could show it to the DCT that I have received all the revenue, sales revenue through my bank account, and the purchasers were 5 in number. I have actually made sales to these 5 purchasers only, not more than that. And all of them have given or paid the revenue through my bank account, which has been reflected here. And I have submitted the bank statements accordingly. So whatever I have shown should be accepted by you. And there is no question or there is no scope on your part to enhance the sales revenue. So the city cannot actually enhance the income here, the sales revenue here. It is not possible. Even if he does it, the appellate authority will not accept it. It will be rejected in the forum of the appellate authority, maybe in the case of the appellate tribunal, or in the case of an appellate joint commissioner or appellate additional commissioner, whoever he is, who hears the case. So that should be the answer, and you can refer to the decision of the Deputy Commissioner of Taxes by citing some reasons. Citing some reasons means I have given you some reasons. That means I have said to you that it should be on the basis of the past record, and it should be like this, that the sale revenue was not supported by vouchers, but it could be different. Say, for example, the sales revenue could have been earned by the SSC through bank statement, and the bank statements have been shown or submitted by the SSC before the Deputy Commissioner of Taxes accordingly. And he has also mentioned the names of the purchasers of his products. As I have said to you, that there are 5 purchasers only, and there was not any other purchaser beyond that. So in that circumstance, the Deputy Commissioner of Taxes would have to accept it. He cannot reject, and reasons should be cited by you. The principle here I have said to you is that the principle of natural justice. So if you do the assessment or make the assessment without any basis, that should be violation of the natural justice. That should be stressed on by you while answering that question. Then come to question number 8. SSC, neither legal nor beneficial owner of a property, whether capital gains can be imposed in the hands for exchange of that property with another property. So elaboration of the case has not been made here, but I have to make the elaboration for your understanding. Here, a property was sold out by a person, and afterwards another property was purchased by the same person, but capital gain tax was not imposed on the first person who sold out the property and then again bought the property. Here the question is, you have to sell out the property. You have to find out whether the property was a capital asset or not, first of all. So if it is a capital asset, yes, capital gain can arise out of that. If it is not, then capital gain cannot arise out of that. So whenever a property has been sold out, you first identify whether that property is a capital asset. If it is a capital asset, the capital gain can arise out of that if you dispose of that property. So the sale proceed, you have to take into account, and the acquisition price of the property you have to take into account as well. So the difference between the two should be the capital gain. However, if there are some other expenses, that means if you renovate the property, or if you can add some value to the property in order to enhance the price of sale, in that circumstance, that expense has to be deducted while calculating the capital gain. That means acquisition price plus the cost of renovation, and that should be added together in order to find out the capital gain. So when you calculate the capital gain, you are supposed to pay taxes on that. That means capital gain tax you have to pay. However, if you buy another property with the same amount, in that case, your capital gain would not be taxed. So that section have to be known to you. It is under section 32. What section 32 says? Especially you have to go through section 32 subsection 5. Section 32 says about computation of capital gains, but you have to go to section 32.5 as this case refers to subsection 5 of section 32. What is said here is that notwithstanding anything contained in this section or section 31, where a capital gain arises from the transfer of a plant, machinery, equipment, motor vehicle, furniture, fixture, or computer, which immediately before the date on which the transfer took place was being used by the SSC for the purpose of his business or profession, and the SSC has, within a period of 1 year before or after that date, purchased a new plant, machinery, equipment, motor vehicle, furniture, fixture, and computer for the purposes of his business or profession, then instead of the capital gain being charged to tax as income of the income year in which the transfer took place, it shall, if the SSC so elects in writing before the assessment is made, be dealt with in accordance with the following provisions of this subsection. That is to say, if the amount of the capital gains is greater than the cost of acquisition of the new asset, the difference between the amount of the capital gain and the cost of acquisition of the new asset shall be charged under section 31 as income of the income year. And for the purpose of computing in respect of the new asset, any allowance under the third schedule or the amount of any capital gain arising from the transfer, the cost of acquisition or the written down value as the case may be shall be nil. However, the gist of this section is that whenever you have sold out your property or capital asset, capital gain has arisen out of that. But it is said that if you buy another property for your business or profession, whatever it is, within 1 year from the sale, from the date of sale of that property, in that case, you can have the exemption from capital gain tax. So the condition is that the sale proceed and the capital gain. So whatever capital gain you have actually earned, if you purchase a new asset with that amount, then there would be no capital gain tax. But if your capital gain is more than the acquisition price of the new asset, in that case, up to the acquisition price of the new asset would be exempted from tax. But the amount which exceeds the acquisition price shall be taxed. That means shall be tax to capital gains. So that is what has been said here. So whenever you are going to advise your client, you have to advise him accordingly whether that would be beneficial for him or not. If he says before you that, okay, I want to dispose of my plant, but it is very likely that it will earn me a capital gain, then you have to suggest whether you need this same asset for your profession or for your business. If you need it for your business or profession, then you buy it within 1 year's time. If you buy it within 1 year's time, in that case, you are not supposed to pay the capital gain tax. Rather, if the amount is similar or the same amount, in that case, it will be totally exempted. If it is not similar or same amount, then up to the acquisition price of the new asset would be exempted from capital gain tax. And the remaining amount, if there is any in your hand, will be taxed. So that should be the advice you have to give. And also you have to give him advice in order to see section 2 subsection 66. Section 2 subsection 66 is also important for you to know. What is said there in the definition section. That refers to transfer. You have to know the transfer. Transfer in relation to a capital asset, when it will be treated as a transfer. If it is not transfer, then capital gain will not arise. But when this is transfer in the legal sense, then capital gain will arise. So that's why transfer in relation to a capital asset includes the sale, exchange, or relinquishment of the assets or the extinguishment of any right therein, but does not include any transfer of the capital asset under a gift, bequest, will, or an irrevocable trust. So you have to see whether it is actually a transfer in the eye of law or not. So whenever you are gifting a property to your relative, maybe, or somebody else, whatever it is. So if it is a gift, then it is not transfer. And if it is not transfer, then capital gain will not arise. Any distribution of the assets of a company to its shareholders on its liquidation. Whenever a company gets liquidated, its assets could be distributed among the shareholders. So if such a distribution takes place, then it is not a transfer. And if it is not transfer, then capital gain will not arise. Any distribution of capital assets on the dissolution of a firm or other association of persons, or on the partition of a Hindu undivided family. So when there is a distribution of capital assets on the part of a firm, when it gets dissolved among the partners, it is not transfer. And if there is an association of persons, and if the assets are distributed among the persons of the association, this is also not a transfer. And if there is a Hindu undivided family and the members of the Hindu undivided family, they have the allocation of properties among themselves, that is also not a transfer, because the Hindu undivided family is getting divided. So that's why it's not a transfer. So capital gain will not arise. So you have to take into account section 2, subsection 66. Okay. Now we can move to question number 9. Whether family expenses of an SSE can be estimated behind its back. That means sometimes you will see that the family expenses of an SSC is to be determined by the Deputy Commissioner of Taxes. It is estimated. You can show family expenses at an amount of taka, say 1 lakh per year for the whole family, but it could not be accepted by the Deputy Commissioner of Taxes. Rather, he can estimate it. So if he wants to estimate it, how can do it? How can he do it? So here it is said, whether family expenses of an SSC can be estimated behind his back. Behind his back means you have shown an expenditure in the wealth statement and the DCT has not issued a notice asking you to explain it. Rather, he just took into account and estimated the expenditure as per his calculation, determination, estimate. So, for example, you have shown your accommodation expenditure at taka 60,000 per month, or maybe 1 lakh taka per month, and your food expenditure maybe at 1 lakh taka, conveyance 30,000 taka, education expenditure for children maybe at 50,000 taka, something like that. So these are the heads of expenditure we have shown in the wealth statement. So the DCT may not accept all those, rather he can estimate the figures. So if he should estimate the figures and he is not convinced of the expenditure we have shown, then he cannot do it on his own like that without giving you an opportunity to explain. What he should do, he should just give you an opportunity of being heard, and then he can estimate the expenditure. So that's why it has been said that the expenditure cannot be estimated behind the back. So when the SSC is supposed to submit the expenditure or the wealth statement, that you have to know. When the person concerned, that means the SSC, has got a gross wealth of taka more than 40 lakhs. That means when the gross wealth of an SSC exceeds taka 40 lakh, in that case, you will be asked to submit a wealth statement or a statement of assets and liabilities, which is also called IT10B. So that is mandatory on his part to submit the statement of assets and liabilities. So this is mandatory. And when the income of the SSC exceeds 4 lakh taka in an income year, then he is to submit a statement of expenditure, that is IT10BB. And the wealth statement is sometimes called IT10B. That is the income tax officers, the income tax practitioners, advocates, they know it very well. And when statement of expenditure is submitted by the SSC, that is called IT10BB. So when it is mandatorily submitted by the SSC, the DCT will definitely take into account asking the SSC to explain it. If your educational expenditure is 50,000 taka, what you have shown in the statement of expenditure, the DCT can ask you how many children you have, where are they studying, whether they are studying in an English school or in a Bengali school, in what class they are studying. So everything could be asked by the DCT and you have to explain everything. So if you can explain that, okay, I have 2 children, and they are studying in a Bengali school, and my expenditure in the Bengali school is 50,000 taka per year. That could be reasonable. But if you say I have got 3 children and all of them are studying in the English school, and my expenditure is 50,000 taka per year, which is not acceptable actually, because in the English school, the tuition fee is much higher than what it is in the Bengali school. So your claim cannot be accepted, and it could be rejected by the Deputy Commissioner of Taxes. Then the DCT can ask you which school you are sending your children to. So the tuition fee structure of their school could be collected by the DCT. So in that circumstances, your claim of expenditure for education of your children cannot be accepted by the DCT. And again, whenever you have shown your accommodation expenditure, if you are renting an accommodation or an apartment or house, whatever it is, then the DCT can ask you which area you are living in. If you are living in Dhanmondi area, then your expenditure for that accommodation could be a reasonable one. So if the rent of the apartment is at least 30,000 taka per month, then you have spent 3,60,000 taka per year. That could be little bit reasonable, but depends on the size of the apartment as well as in the area where you are living in. So those should be the considerations to be made by the DCT. However, if he does not give you an opportunity of being heard, he cannot actually estimate the expenditure. That means he cannot make the estimate behind your back. First of all, you have to give your opinion. You have to argue with the Deputy Commissioner of Taxes. You have to state the reasons why you have shown that expenditure under different aids and whether they are justified. If you can prove that they are justified in that circumstance, of course, the DCT would not be able to enhance it. Rather, he has to accept whatever you have shown. Here, one question. Sometimes you can find out that the SSC is mandatorily submitted to submit the return, but if he is not mandatorily supposed to submit the wealth statement along with the return, still then he can submit the wealth statement if he wants to. But the question is, he is not supposed to submit it mandatorily, but he can voluntarily or willingly submit it. And that is also possible. That is not restricted. The question may arise why the SSC should submit the wealth statement or the statement of assets and liabilities voluntarily. This might be a question in the examination. The question is, if I think that I want to submit the wealth statement voluntarily, it gives me some benefits in future. What are the benefits? The benefits are from the legal point of view. And what kind of legal point is that? That is, whatever expenditure you have shown, you have also shown the savings you have made. If your expenditure is 50,000 taka, and if your income is 1 lakh taka, in that case, your savings would be 50,000 taka. That is very normal. So whenever you have shown your income to a certificate, maybe, let us suppose that you are service holder, or you are working with a company, and you have submitted your return showing some income, but your income is not that high, and at the same time, you are not supposed to submit the wealth statement, but you have submitted it. You have submitted it because you have shown the expenditure that you have incurred for the whole year. And there you say that, okay, I earned taka 1 lakh per year, and I incurred an expenditure of taka 50,000. So 50,000 taka was saved by me during that year. So if you can show such a saving every year for 5 years, then what happens? You can show 2,50,000 taka for the 5 years, or if it is 7 years, 3,50,000 taka. If it is 8 years, it is 4 lakh taka. So this is your legal income, and it should be accepted if you invest that income in future. This is just an example. So from that viewpoint, SSE can take into account that fact that he should submit the wealth statement voluntarily in order to gain some benefit in future. Gain some benefit, that means benefit of having a legal income. And there is no bar to that. That means you are not restricted, or you are not prohibited from showing or submitting the wealth statement voluntarily, even if you are not mandatorily submitted to submit the same. That is the reason why you should do it. Okay. Okay, would you require any break?
Yes, sir. Prayer break. 20 minutes will be great, sir.
Okay. So if you want to go on a break, you can go there. Go on a break for 20 minutes, please, and come back after that.
Thank you, sir.
Okay. Okay, I hope everybody has come back.
Yes, sir.
So we can go to question number 10.
Yes, sir.
SSC's accounting year ended on 30th September 1983. Whether his income tax assessment to be completed under the provisions of the Income Tax Act 1922 or under the Income Tax Ordinance 1984. So the current income tax ordinance that we have now was enacted on the first day of July 1984. So this is Income Tax Ordinance 1984, but earlier we had another Income Tax Act that was called Income Tax Act 1922. So that was introduced in the British period. But there were amendments, of course, through Finance Acts. And in that way, we are assessing incomes of people to tax. But here you have been given one scenario, and that scenario is the SSC's accounting year ended on 30th September 1983. And since the Income Tax Ordinance came into being on the first day of July 1984, whether the assessment should be completed under the Income Tax Act 1922 or under the Income Tax Ordinance 1984. So that was a case actually, a case reference is here. And in the case it was held, it should be assessed under the provisions of Income Tax Act 1922, as it is stipulated in section 186 of the Income Tax Ordinance 1984 that there is no ambiguity in the contents of section 186 of the IT Ordinance 1984. Alauddin and Tawa Textile Mills Limited versus Commissioner of Taxes, Dhaka North Zone, Dhaka. That was the case reference. And it was held in the High Court Division on 17th August 1999. The Income Tax Act 1922 has been repealed. Notwithstanding the repeal, the Income Tax Act 1922 and the rules made thereunder shall continue to apply as if that act had not been replaced, nor any income of or relatable to any period prior to the commencement of this ordinance, and to any notice issued or an assessment order or application or appeal made by proceedings commenced or any prosecution instituted under that act. So what has been said here is that although Income Tax Ordinance was introduced, but here the income year or the accounting year fell under the Income Tax Act 1922. So 1922 could be applied. That means the assessment could be completed under relevant section of Income Tax Act 1922. Because in section 186 of the IT Ordinance, it has been said that there is no ambiguity in the contents of section 186. The Income Tax Act 1922 has been repealed. It has been said in the case reference that Income Tax Act 1922 has been repealed. Notwithstanding the repeal, the Income Tax Act 1922 and the rules made thereunder shall continue to apply. That means the DCT can continue to apply the rule or the provision as if the act had not been repealed. So that is the decision of the case whenever. So what is the essence of this case? The essence is that whenever a new act is enacted and an old act has been repealed. So if any proceeding has been drawn under the previous act, that shall prevail. So that is not illegal. So here, since the accounting year fell under the Income Tax Act 1922, and after that, the Income Tax Ordinance has been introduced, still the assessment could be made under the Income Tax Act 1922. So there is no problem with that, because the High Court said that although the Income Tax Act was repealed, but still then the provisions of that Income Tax Act shall continue to apply to the contents of income, and they will stand valid. There is no problem. So the case has been given for that reason. And if you face such a problem in future, whenever there is a transition period, and if you see that an income has fallen under the Income Tax Ordinance 1984 and another Income Tax Act has been introduced afterwards, so the assessment could be made under the relevant section of the Income Tax Ordinance 1984. And all the legal proceedings that have been drawn by the Deputy Commissioner of Taxes for the assessment purposes shall stand valid. So that you have to keep it in mind. We can move to the next question. When books of accounts can be rejected? That means the assessee has maintained books of accounts, but when those books of accounts could be rejected by the Deputy Commissioner of Taxes. If you submit books of accounts and the books of accounts are having vouchers, having receipts, documents, evidences, etc., and all these are supported by daily books or daily registers, inventory books are there, bank statements are there, cash book has been maintained. In that case, books of accounts cannot be rejected. But when it could be rejected? So here is also a case reference, and the case reference is N. Muhammad Engineering Industries Limited versus Commissioner of Taxes, Zone 2, Chittagong, and that was held in the High Court Division on 2nd of December 1999. So in the case, it was said books of accounts cannot be rejected by the DCT if there is no finding by him that method of accounting which has been employed by the SSC is not regularly employed by him, or that the method was such that, in his opinion, the income of the SSC could not be deducted therefrom. It should be deduced. It should be deduced therefrom. So what is said here, when the method of accounting has been employed by the SSC, which was not regular, that means one method of accounting was used by the SSC in a particular income year, and in another income year, method of accounting was different. So if it is so, in that case, books of accounts could be rejected, and that is the decision of the case. Or if the method is such that, in the opinion of the Deputy Commissioner of Taxes, the income of the SSC cannot be deduced therefrom. And if the method is not very clear or distinct in the opinion of the Deputy Commissioner of Taxes, and from that method, he cannot determine the income of the SSC. So if it is so, in that case, the books of accounts produced by the SSC could be rejected. So that is the case reference here. But In general, you can also add some points here. The points are that when books of accounts are produced by the SSC, but they are not verifiable. Let us suppose that the SSC has submitted sales book and the figures have been mentioned in the sales book, but there is no mention about the purchasers. That means who purchased the goods from you. Those are not mentioned. So if those are not mentioned, you cannot verify whether Mr. X purchased goods from you or not, whether Mr. Y purchased goods from you or not. So that is not possible for you to determine that, to verify that. If you cannot verify that, in that case, the books of accounts could be rejected. Or if the inventory book has been maintained by the SSC, there should be a closing inventory book and there should be an opening inventory book. But the price has been mentioned, quantity is not mentioned. And from whom the goods were purchased by the SSC were not mentioned. So under those circumstances, of course, the inventory book could be rejected. And if you say that, okay, I have sold out my goods for cash only, not through bank, that would be verified only by verifying two cash books. One cash book, that is your cash book, and another cash book is maintained by the purchaser. If you verify your cash book, that means you have received a particular amount of money which has been recorded in the cash book. And at the same time, if you verify the cash book maintained by the purchaser, the similar figure has to be there. He has paid it off. So that cash has also gone out of his business. And your business has actually received that amount of money from the purchaser. So the two cash books maintained by yourself and the purchaser should be verifiable. And if could be verified, then the DCT can accept it. If not, then he can reject it. But if you say that, okay, I have sold out all my goods through banking transactions, that means checks, through checks. I have received checks from the purchasers and I deposited the checks into my bank account and it was collected through bank account. In that circumstance, of course, if the sale figure, what you have shown in the books of accounts and whatever you have received in the through the bank account is same or matches, in that case, that should also be accepted by you and the DCT will also accept it. So books of accounts could be rejected whenever your answer should be like this, whenever methods of accounts have been different. One method in 1 year, another method in another year, or the method of accounting that has been used by the SSC, it cannot reflect the proper revenue of sales of the SSC, or whatever I have said, whenever books of accounts have been submitted, but they are not supported by vouchers, or they are not supported by other evidences. As I have given you an example that there is no mention about the names and addresses of the SSCs, you cannot verify the purchasers. So in that case, the books of accounts could be rejected by the Deputy Commissioner of Taxes and he can estimate the sale. Then we can go to question number 12. Whether entertainment allowances can be given in case of loss. So this is relating to section 30 and rule 65. So all the allowable expenditures are under section 29. And all the disallowances are under section 30. And rule 65 is also there with regard to entertainment allowances, the limit of the entertainment allowances. But here the question is, when you have a positive income, that means when you have profit, you can claim entertainment allowance or entertainment expenditure. But in case of incurring a loss by you, whether you claim it or not, if you claim it, whether it will be acceptable by the Deputy Commissioner of Taxes or not. So you should actually consult section 234, definition section. In the definition section, income has been defined. What should be treated as income? We know that income is a profit or gain, but it also includes loss. The income should also include loss. So that should be negative income. Otherwise, if there is a profit, it should be positive income. So since income includes loss, so if you incur loss in the business, it could be said that it is your negative income you have actually earned. So the entertainment expense or the allowance could be given on the income, whether it is negative income or whether it is positive income. So the case reference is like that. It is Shat Gurmukh Singh versus CIT, Commissioner of Taxes, Income Tax, Punjab, 1944. So that was the decision in the case that even if there is a loss, you can claim the entertainment allowance, and the DCT can also allow entertainment allowance. So here, the Rule 65 of Income Tax Rules 1984 should be consulted. The limit of the entertainment allowance should be there, and the DCT could allow in the assessment order. So you can refer to that case. The answer would be what I have said now. Then we can move to question number 30. When assessment or reassessment becomes barred by limitation of time. Assessment completed under section 83(2) on 30th June 91 for the assessment year 1988, 1989. The assessee filed appeal to the Commissioner of Taxes Appeals against the assessment. The Commissioner of Taxes Appeals disposed of the appeal under section 156 on 10th of March 1993. The DCT did not revise the assessment but sent to the Commissioner of Taxes Appeals order in time as stipulated in section 94(3). But went on second appeal to the tribunal against Commissioner of Taxes Appeals order. The tribunal disposed of the appeal on 5th of April 1995. No stand taken by the SSC before the tribunal, that is, the DCT did not revise the assessment pursuant to the Commissioner of Taxes Appeals order, it has become barred by limitation. Okay. You can go through it, whatever it has been stated in this question, but gist is that whenever an assessment has been made by the DCT and there is an appeal against that order, the appellate authority, whether he is appellate joint commissioner or appellate additional commissioner or commissioner of taxes appeals, whoever he is, will issue an order. Issue an order means will issue a verdict regarding the assessment made by the Deputy Commissioner of Taxes. So it is mandatory on the part of the Deputy Commissioner of Taxes to revise the assessment according to the instructions given by the appellate authority. So he has to revise the assessment under section 156. So let us suppose that the assessment was completed under section 83(2), that is after taking hearing of the SSC by the DCT. And the SSC referred an appeal against the order of the DCT. Now the appellate order has been given by the appellate authorities. Let us suppose Commissioner of Taxes Appeals has given the order. And now the DCT, what he has to do is that he has to revise the assessment under section 156 and issue a new assessment order following the instructions given by the Commissioner of Taxes Appeals. So he has got a time limit under section 94(3) to revise the assessment order. If he does not do that, it will be barred by limitation of time. That is, he cannot make it afterwards. If he does not do it within the time, he cannot make it afterwards. So here, what happened? What happened is that the DCT did not revise the assessment order as per instructions given by the appellate authority. Rather, what he did, he actually preferred a second appeal. Second appeal means he preferred an appeal against the order given by the appellate authority to the higher court. Higher court means the tribunal. So tribunal is the higher court than the appellate authority. So when the DCT preferred an appeal against the order given by the Commissioner of Taxes Appeals, the tribunal took into cognizance or the SSC and the department. Department means taxes department, that is the DCT. So there is a departmental representative. Departmental representative always works in favor of the department. That means the taxes department, meaning the Deputy Commissioner of Taxes. So SSC will have his representative and the DCT will have his representative as well. So appellate tribunal will hear the case and give a verdict. So in this case, the appellate tribunal heard the case and gave a verdict. And that verdict was given under section 159. That means the Deputy Commissioner of Taxes, when he received the instructions from the appellate tribunal, he revised the assessment under section 159. So this assessment was a fresh assessment as per the instructions given by the appellate tribunal. So since I have said to you that appellate tribunal is a higher court than the appellate authority, and the DCT has revised the assessment as per instructions given by the appellate tribunal. So this is a fresh assessment and this is valid, legal. So since the DCT did not revise the assessment following the order given by the appellate authority, that was his fault. But as the tribunal has given an order and the DCT has followed it, now this assessment is legal and valid in the eye of law. Although it was barred by limitation before, but now it is not barred by limitation. So it has got a fresh life. This is a fresh life of the assessment and it will stand valid in the eye of law, and the SSC has to pay taxes on the basis of the revised assessment, what the DCT has made following the instructions given by the appellate tribunal. So that has been said here. Pursuant to the tribunal's order under section 159, dated 5th of April 1995, that the city revised the assessment in time. He did it in time, so it was not barred by limitation of time. The SSC went on appeal to the Commissioner of Taxes Appeals, holding that this revised assessment is illegal, as no assessment was made pursuant to Commissioner of Taxes Appeals order dated 10th of March 1993 under section 156. Being unsuccessful at Commissioner of Taxes Appeals stage, the SSC filed second appeal to the tribunal, holding that the Commissioner of Taxes Appeals was not justified in upholding the DCT's revised assessment, as the DCT failed to revise assessment pursuant to Commissioner of Taxes Appeals order on 10th of March 1983. The point for this maintainable in law in view of section 94(3), as the DCT first failed to revise the assessment pursuant to city's order dated 10/3/1993. So what happened? The original assessment was at stake before passing the order by the appellate tribunal, but soon after tribunal's order, the original assessment got fresh lease of life and merged with the tribunal's order, and the DCT, who was on default for not revising the assessment order pursuant to city's order under section 156, took privilege to revise the assessment under section 159 in time, and saved himself from the mischief of limitations in revising assessment under section 94(3). So the gist is that whenever the tribunal's order, the higher court's order has been revised by the DCT, so the assessment has got a fresh lease of life, and that is valid in the eye of law. So whatever the DCT did in the past, that is, he did not revise the assessment, that was a fault on his case, but the limitation of the time of assessment should not be an obstruction in the recovery of taxes from the SSC as a valid assessment. So that is the case. And you can just remember it, the gist of the case, and then if there is similar case in the examination in future, or if you face such a problem in future, you can answer the question in that way, following this decision given by the tribunal and the reference we have used here. Okay, you go through it, the fact has been elaborated here, and answer has also been given. If you go through it properly, then you will understand what you should do in future with regard to such a circumstance. Anything to know, or you just understood? Go through all these questions and facts. Maybe some questions are relating to general income tax provisions. That means you have to decide something according to the understanding of the Income Tax Act or Income Tax Ordinance, whatever it is. So if you have the proper understanding of the provisions of Income Tax Ordinance 1984, you would be able to answer the questions properly. And Some points are of course interesting in my opinion. If you can go through all this, maybe you will have to answer, or you will have the opportunity to resolve some of the tricky points. I hope you are okay. If you have any question, you can ask me. If not, then we can stop here.
Okay, sir. Thank you, sir.
Okay, so wish you all the best.
Thank you,
Your
sir.
examination is knocking at the door, so I believe that you will be able to answer the questions properly in the income tax subject, which is a little bit difficult for many people. But if you find any interest in the income tax ordinance, you will be able to answer the questions properly. But sometimes you should remember the sections, subsections, etc., in order to answer a question properly or effectively, or to make people understand that you read all the provisions and gone through them. So the examiner will have a very good evaluation about what we have written in the examination. So try to do in that way, putting the sections and subsections, etc. And if you can give some case references, that will also help you a lot, because the examiner will assess you from that direction, that you actually studied some cases which are actually required for you to solve the problems in future if you are a practicing chartered accountant. But even if you are not a practicing chartered accountant, you are working with an organization, definitely you can work in the interest of the organization if you have some case studies in your knowledge. Okay. Thank you very much for your attendance. Hope to see you in future and wish you all the best.
Thank you, sir.